Hey guys, it's Deepak Shukla here from Pearl Lemon Properties. Please do click the link in the description below to get access to our free training on how to get a mortgage for less than £100 per month, as well as achieving a rental income of £400 or more on a monthly basis every month instantly. We'll show you exactly how you can do that. Welcome back, and today we're going to be talking about property investment strategies again, and really interesting. I'm quite excited to talk about this actually because what is it that you should go for? Is it rental income versus yield versus the fundamentals, or rental income versus capital growth? Okay, and what is the mix and the measure and balance of the two that you should be considering? So depending upon your buy to let investment strategy, there's different things that different people, favor. So if, for example, you're in the game of capital growth, then over, for example, a 10-year period, what that means is really simply that you invest in a property. Okay, the property probably has a bit of a higher cost, but that property can become worth a lot more down the line. And it means in the interim to that period, you'll still make kind of some cash flow, but you'll make probably slightly less. So if you're buying, for example, a £300,000 property versus a £50,000 property, as you can imagine, the mortgages for both are going to be very different. On the 300k place, you're looking at what, 30, 60, probably about £70,000. If we get up to the stamp duty and all of those pieces, then you're looking at probably the £85,000 mark as an example. Whereas with a 50k place, you're looking at probably, 20,000, £23,000 all in, something like that. So, 20,000 versus 70,000, okay? 30, 60, 10, 10, 30, 60, 70. Yeah, like 20,000 versus even £80,000, okay? So there's a kind of 6x difference there, which means that you could, in theory, buy, at the 50k mark, you could buy 20, 40, 60, you could buy 4 properties for the same price as the 300k property. So the rental incomes on this one, the 300k place, your net return might be, for example, £600 per month. Here, it might be £250 per month, but then 250 times 4 equals a couple of £100 more, or maybe it's £300 a month. So, you know, I wanted to walk through some of those potential numbers just off the top of my head to give you a sense of, which it is that you prefer. And there's absolutely no right answer here, okay? Um, with capital growth, of course, the downside of it up front is that there's always going to be a more significant cash outlay because you're buying a place that's likely over time to experience some capital growth. And generally speaking, that's going to be a property that's a bit more expensive than something that's, on the cheaper side. The other challenge with stuff that's on the cheaper side is it probably comes with problems. It probably comes with disrepair or not the best tenants and less capital growth and therefore more costs. So then the yield, i.e. the 12% plus return for like a £50,000 place, over time becomes quite a lot less. Okay, now that's the challenge with cheaper properties. The attractive thing about cheaper properties is that they're cheaper properties, so you can purchase them, a lot more quickly than you could more expensive property, and you can build your portfolio faster. But then, of course, there's the additional cost of management fees. Okay, so my place, I've got my father involved because I've got properties I've got 2 properties at 30,000, 30,000. Got another two that's like what, 77 and 105. Um, bum 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 bum. I've got, yeah, that's 4. So 77, 105, 30, 30, and then 205. All my properties are less than 300k. I'm in the process of trying to buy, a bigger one that's 410k, which is a bit more involved. But as you can hear, it's properties that are definitely, well, it's a mix actually, interestingly. So some of them are capital growth more. The 77k and 105k are in an area that should show some capital growth over the next 10 years. It's Dudley. The two that are 30k are in low income area, and I'm probably not going to see any capital growth, but they were cash purchases. Okay, the one that's 205 near my mum's place, that's near Heathrow Airport, so that should see capital growth over the next 10 years as the Crossrail comes in. Then, so a combination arguably is a good approach to take, but it really depends upon the investment style that you have and what you prefer. And of course it is difficult to see the upside of capital growth over 10 years. And I mean, the irony of this is that of the 5 properties I've got, 3 I think I'll see capital growth, 2 I think I won't. And if I look at my next purchases, again, it's a combination. So I think diversification is a big part to consider within this. But again, consider these nuances because there is more management and more involvement with the cheaper properties. It can all still be managed, even if you're time poor and cash rich. All of it can definitely still be managed, but you need to give some consideration whether it's rental income, yield, or capital growth that you prefer. And obviously, each will give capital growth will give you rental income as well. Okay, it will just be slower, and you can't achieve as much rental income as quickly as you could with capital with 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 rentals. Me, broad strokes, it's clear on balance that I prefer the cash flow because they're still all cheaper properties. And me getting, for example, a couple of 400 grand properties, or properties that are specifically focused on, that capital growth. It's gonna just ultimately, take longer for me to build my portfolio. So everybody's a little bit different. It is subject to your pocket and your ability to generate additional income. But thinking about this is something that definitely should be at the forefront of your mind as you begin to build your investment portfolio. So please do check the link in the description below to get access to our free training on how you can get a mortgage for less than £100 per month with an instant cash flow of up to £400 plus per month. And please do, of course, subscribe if you enjoy these videos. Let me know what questions you've got in the comments, and I'll catch you in the next training. See you guys.